Hi, Russell. Thanks for being here.
Hi, Christine. Thanks for having me.
Yeah, hi everyone. I see a couple people watching now. So we're live on LinkedIn, Facebook, and YouTube. So Russell, thank you so much for joining me. This is actually a very interesting topic because mortgage is hot now, and then with the COVID, and then so there's just a lot to talk about. So it's a pretty heavy topic. So everyone, feel free to ask any questions you want from Russell, and he's an expert with the mortgage stuff. So why don't you introduce yourself, Russell? Just let people know what you do and in what state do you serve.
Sure. So, my name is Russell McDonald. I'm with YMAC Capital. We are mortgage brokers in the San Francisco Bay Area. My company is 30 years old, and we serve California and Utah right now. We have been in other states before, and we'll be expanding back out again at some point. And so, most of what we do is residential real estate loans. My experience doing this literally since the end of 1991 is when I started here. And I started actually working as a loan officer in 1992. And so I've learned a lot about the way the housing markets and the finance markets work, um, because I've been doing this since even before the mortgage industry had FICO scores. So
Mm.
I've been able to see how a lot of things have changed. Um, Something that you probably don't know about me, Christine, is I also, back in 1994, I started a software company to create tools for the mortgage industry that didn't exist.
Mm.
And we've primarily been using two of those tools to make almost all of our revenue since 1998. And what we came up with is so unique. I've actually been awarded 6 patents for
Oh,
the software systems and business methods that I've created to make getting a mortgage easier and better.
that's
So
awesome.
I'm very old school when it comes to things here, and I've been around a long time.
Yeah, that's awesome. That's awesome. So I know you've been in business for a very, very long time. So if you can summarize in one sentence, like what has changed, or like the from whatever back then 1994 to now, like how would you describe it?
Um, it doesn't even look like the same business at this point. The technology has completely changed. They've tried to use technology to replace the experts in the transaction.
Mhm.
And the companies that are most successful don't try to get rid of the high cost experts that they have at the table, but they use the technology to enhance what they can do and make it so
Mhm.
that that expert can do exponentially more business.
Yeah. So what was the highest and the lowest mortgage rate you've seen since 19 you said 1994, right?
1994 is when I started my software company.
Oh, 1990.
1991 is
Now
when I
what? Okay.
started here.
Yeah, so
So,
1991 till now.
um, back when I just got into this, we were seeing A paper 30-year fixed rates at about 9% with a two
Wow.
point cost. And
Wow.
people were excited that we were down into single digits again. Yeah, crazy.
Yeah, yeah.
And
Wow.
then in 1993, when we had that big wave of refinancing and everybody thought we got
Mhm.
the lowest rates ever, those rates were in the sevens. So, we've had every 5 years or so, we just have another big rush where we go down below the previous
Mhm.
lows. And this is no exception. Prior to right now, the absolute lowest we had in interest rates was about 3 weeks before the presidential election in 2016.
Mhm.
Um, and rates started edging back up towards the election when it looked like things were a little bit less stable than we thought. And then the economic markets were taken completely by surprise with the results of the
Mhm.
election.
Mhm.
So 60 days after, rates were probably up a full percent higher than they were right
Mhm.
before. It's just crazy how fast things can move. So the
Well,
highest,
mhm.
close to 10%. The lowest we've seen, I've got lenders right now that are closing 15-year fixed rates at 1.99% with some
Wow,
hefty
that's
costs.
that's
But
very
yeah,
good. Yeah, yeah.
um,
Okay. Okay.
go
So
ahead.
what usually determines the mortgage rate? Like what should people like look out for that kind of will trigger the mortgage rate going up or mortgage rate going down?
I would have had a much better answer prior to March, um, because since then, when you've seen, usually we've tracked up and down along with the 10-year
Mhm.
treasuries.
Mhm.
Um, our rates haven't gone as low as they should based on where the treasury rates are right now because none of the rules apply. And it's just crazy where things are right now. But in general, when you see the treasury markets doing better and those rates dropping, on those days, mortgage rates tend to go lower or higher with that market.
Mhm. Yeah. So what really determines the mortgage rate? Because like it's pretty much like lending. Like Fannie Mae
Yeah.
is the one who, yeah.
So
Mhm.
it's the price. It's what they're getting for the mortgage-backed securities. So
Mhm.
people are buying pools of mortgage-backed securities, and their appetite for rates going up and down basically determine how the lenders price things. But right now, when the lenders are so uncertain about what their future is and what's going on, um, sometimes there are things that are just outliers. Um, I had a loan that I was trying to price out for somebody about 2.5 months ago,
Mhm.
and they were trying to get a cash out home loan, and
Mhm.
literally from one day to the next, the closing costs went up by $35,000 for that loan because the lender got scared when things were unstable. And when the CARES Act came
Oh.
out and made it so that lenders were obligated to grant forbearance for up to 6 months with no questions
Mhm.
asked,
Mm.
all that had to happen is the client had to say, we are in
Mhm.
a hardship because of COVID, and they had to give
Mhm.
forbearance. But
Mhm.
those lenders had commitments to the people that they were selling the loans to when they were
Mhm.
servicing it to make those payments to that party. So they'd still
Mhm.
have to keep making the payments even when the client didn't pay them.
Got it. Exactly. That's a pretty high risk. So now with the
Mm-hmm.
COVID, like we're already a couple months into this virus, and then I don't know when it's gonna end. But so how has the housing market changed? Like the interest rate went down, and then I feel like, I mean, you get different opinions from realtors, right? It's like, oh, the market is really doing good. Like I'm moving to Las Vegas, Nevada, and then they all say, yeah, the market is still very good. There's still offers. So I'm sure Bay
Mm-hmm.
Area is probably still the same. So it's like, what have you
It
noticed that?
really is crazy
Mm-hmm,
because we don't have as much inventory. They've really clamped down on the rules for realtors when it comes to showing homes.
mm-hmm,
In California, you can't have a regular open house, but you can take appointments to walk people through two at a time.
mm-hmm,
Um, and so some lenders or some realtors have tried to set up, you know, a window on a Saturday where they book 8 or 10 appointments one after the other so that they
mm-hmm,
can effectively have a private open house for those people in
mm-hmm,
15-minute intervals. Um, and it's surprising because you would think so many people are out of work, so many people lost their jobs, which means they can't get a mortgage. And you would think that that would be causing things to drop off. But with the limited inventory, if a house is
mm-hmm,
priced right, it still goes really fast. And we're still seeing
mm-hmm.
lots of competition and people that are worried that with because of the scarcity are bidding the prices up.
Got
And
it.
we don't, in the last financial crisis, it was
Yeah,
basically housing related.
yeah.
We had the situation where people were losing their homes left and right, so they had to sell, and they had to sell now, and they didn't have a choice. Well, right
Mm-hmm,
now, everybody that's in trouble, if
mm-hmm,
their loan is owned by Fannie Mae or Freddie Mac, or if it's a VA or FHA loan, they can just call up the lender and get 6 months no payments. So they're not in a hurry to sell. And you know what happens at the end of that 6 months? If they
mm-hmm,
still can't make their payments, they get another 6 months. And the lender is not allowed to say no in most cases.
mm-hmm,
If it's the lender's own money, the rules are different. But
mm-hmm,
under the CARES Act, anything that the government has a link to in the financing,
mm-hmm.
they're obligated to give up to those 12 months. And then after
Yeah.
that, if they still can't make the payments, it would take the lender about another 6 months to foreclose. So people that are in trouble are looking forward a year and a half and saying, I'm probably going to be able to make it work before then. And so they're not panic selling.
Oh, I see, I see. So they can literally stay not paying anything for another year, right? Before the lender is
Mm-hmm.
actually can legally kick them out of the house and then say we're gonna take.
And in California, it takes about 6 months to actually foreclose.
Wow.
So
So they, but then
yeah,
I guess they can literally live for free. But how's that's gonna affect their credit though?
it would ruin their credit.
But then they're
Yeah.
probably like, hey, I got free rent.
Well, if someone's that desperate and they need that year and a half to pull things together, let's say it's a business owner that's been devastated, but they still
Hmm.
know how to run a business. They know what to do,
Yeah.
and if their current business crashes, they can start another business. They may be back on their feet in less than 18 months and able to bring
Hmm.
everything current and be fine. But you're right.
Hmm.
They're okay. So while they're in forbearance, the lender's not allowed to mark them late on their credit. Now,
Hmm.
the credit report does say it's in forbearance, so that's other problems. We've got rates in many cases below 3% right now, and people that
Hmm.
are in forbearance or have been in forbearance usually don't qualify for those rates
Got
because
it.
it's a risk for the lender, and the lender doesn't want to be making a loan to someone that's saying, I can't make my payments right
Ah,
now.
got it. Got it. So if you have a forbearance, it doesn't really serve you later on when you look for another loan, right? Because it will be on your record, right?
It makes it harder, but again, because this is federally mandated, they came
Mm-hmm.
out with some new rules about a month ago to
Mm-hmm.
where after you bring your forbearance current
Mm-hmm.
and make another three payments, they'll basically look the other way and you can get a normal financing.
Got
So,
it.
this is a disaster. And
Mm-hmm.
so they're taking a look at it from the standpoint of once they get back on their feet, if they put everything behind them and show that they're still able to meet all their
Mm-hmm.
obligations,
Mm-hmm.
then we no longer penalize them. Now,
Got it.
I was worried that they were going to penalize those people for a lot longer. Let me
Mm-hmm.
give you an example. Back in 2007, it was possible for you to walk away from your house and file bankruptcy and buy a new home in less than 2 years with
Mm-hmm.
a paper credit and loans.
Mm-hmm.
Millions of people did a strategic default in that time, thinking that in 2 years later they'd be back on their feet and buying another house or buying back the same house in some cases.
Mm-hmm.
And so the rules changed because
Mm-hmm.
so many people were taking advantage of it. And it stretched out to as much as 7 years being required post foreclosure or post bankruptcy to get back into an A paper loan.
Mm-hmm.
Now it's come back down a little bit. It's about 4 years for most loan programs. For some, it's 3. But still, before the last financial crisis, I literally had some people who walked away from homes, filed bankruptcy, and less than 18 months later were getting approved for a new home.
Mm-hmm. Got
So that's why I was expecting the rules to stretch out longer when it comes to that. But the way they're applying it right now, 3 months after bringing your forbearance current, you can usually qualify for the best financing.
Got it. Okay, cool. So like the rates I noticed, like it went down, right? When because of
Mm-hmm.
COVID. So tell us more, like yeah, like how has the rates been affected? I mean, like I've never seen in 2 point something percent. You said 1.99% now. I was like,
Now, the
we're like,
1.99%, that's a 15-year fixed,
yeah.
and it costs quite a bit to get it. So, if you
Oh,
have a
you mean the
$400,000
close?
loan,
Oh, okay.
you're going to have, I don't know, on a $400,000 loan, you're going to have $10,000 to $12,000 in closing costs to get it. Is
What?
that worth it? Well, it's 1.99%. You're going to make up that money pretty quick. Now, my preference is usually to find a tier where the bank will pay all the closing costs for you in exchange for a higher rate. Now, if that
So.
higher rate is lower than what you're paying, it still
Mhm.
makes sense.
So why does it cost more? Is it because they're buying down the points to 1.99?
Yeah, they're basically paying
Oh,
points
okay.
plus closing costs to get the rate lower, and the
Okay,
lender's
so
offering a special to make it
okay.
be within reach.
So what if they're not paying anything points to lower it? What would be the regular 15-year mortgage?
I had a 15-year fixed earlier this month that we did with paying all the closing costs, so no points, no fees,
Mhm,
at
mhm,
2.75%.
mhm. Okay. Yeah,
Um,
it's still pretty good.
it's
Yeah.
fantastic.
Yeah.
I mean, those rates have been unheard of.
I know,
Um,
I know. That's like gotta get a refinancing or buy a house soon. So okay. So
mhm.
what do you see? I mean, with the coronavirus and how do you see that affecting our housing market and the interest rate for a few more months till beginning of next year? Like, because you have so much experience. Like, if you, I mean, like I
Mhm.
know you don't have a crystal ball, but what do you? How do you see the market going the next couple of months while we still figure things
because
out?
people
Yeah.
because people aren't getting desperate, I don't think you're going to have the panic selling and the price drops.
Mm.
Now, I would imagine there are parts of the country where things are a lot more tense is on the housing front. Um,
Mm-hmm.
Around here, we had what, 40 million people unemployed at one point. Now it's down to about 20 million. But the people that are generally unemployed are lower end employees, hourly, salaried workers. Here around the Bay Area, I found very few people among my clients that are actually furloughed or laid off in any way. Um,
Mm-hmm.
so I don't think that prices are going to get drastically affected. Um, a little bit further out, say Antioch and Brentwood, we've seen some things kind of quiet down a little bit. It's not going up as fast, but it still
Mm-hmm.
seems to be going up. Um, so I don't think we're going to have the negativity on price. Also, in part because interest rates are so low that it's more
Mm-hmm.
accessible. So when that interest rate is below 3%, it's one of those things where people can afford more house. I had a couple who closed a loan just last week who purchased a home with a 30-year fixed rate at 2.759%, and they didn't pay any points for it. Now they had their
Mm-hmm.
normal closing costs with the purchase,
Mm-hmm.
but that's something to where they were talking to me about possibly paying down faster, and could I give them the schedule if they wanted to pay it off in 15 years instead of 30. And what I said
Mm-hmm.
is, with the rate this low, pay everything else first, because this is a super low rate, plus it's tax deductible. And if you have other things, their kids are getting to the point that they might be going off to school and things like that. And I said, save your money right now. Um, when you have more money in the bank, sure, if you want to throw more money at this, you can, but there really is no reason to, because this payment is so low, you guys can make it easily and just skate
Mm-hmm.
on by for the next
Yeah.
30 years.
Yeah. So, Russell, what do you think triggered the interest rate to go down?
All of the fear and the instability in the economic markets.
Mm-hmm.
And if you remember, we had the the stock markets just getting
Mm-hmm.
decimated 3 or 4 months ago.
Mm-hmm.
And so a lot of money was going into bonds. But the real play here, the reason that things are going so low and so
Mm-hmm.
hard, is all of the money that the government and the Fed is pumping into the economy. In the Fed's
Mm-hmm.
minutes yesterday, they basically said, we will do whatever it takes to get this economy back to full employment. And we will keep rates low until that happens. Um, and part of what they're doing to keep it low is they're not just buying treasuries, which keeps that low because they've got more demand now because they're paying more money,
Mm-hmm.
but they're also buying mortgage-backed securities. And they're buying
Mm-hmm.
billions of dollars a day in mortgage-backed securities. So that's also keeping those rates low.
Got it.
And Fannie Mae's economists predict that the average 30-year fixed rate next year
Mm-hmm.
will be below 3%. That's the average.
Okay.
So we're going to have low rates for quite a while unless
Mm.
things drastically change.
Got it. Got it. For a while, meaning for another year or two, you think?
At least.
Okay.
Um,
Okay.
I wouldn't be surprised if it takes 3 years to really get the economy back on track.
Got it. Got it.
So,
So they want to keep it low. That way, it encourage more people to keep buy a
mm-hmm,
home, and then So even with the layoff and the unemployment, and then I
mm-hmm,
guess you don't see that affecting the market too much, because then they, even if they can afford, like, because there's forbearance and stuff like that, so they're
mm-hmm,
not like desperate to sell it anyway, even though they don't have a job, because they don't have a big mortgage to pay, right? So it doesn't affect it
correct.
as much. So, but then what if, like, it's over, like, the year is, oh, I don't know, 6 months is over, and then they don't have a job yet, then I guess they're just gonna keep staying there till, like, they get kicked out by the lender, and then they're gonna have to find a rent, but then
They
they might have a
could.
hard time. Yeah. Uh-huh.
They could, but if that happens to millions of people, then they're not going to have a hard time finding rental units, because there are so many other people that are going to be in the same situation. The
Mhm.
landlords are going to have to take a look and say, okay,
Yeah.
why did this happen? Can I get comfort that it's not going to happen again? Now, this is dangerous for the landlord too. They were
Yeah,
talking about here in
exactly.
California staying evictions for up to a year, which means
Yeah,
tenants
yeah.
could not pay rent.
Mm-hmm.
which would mean the landlords wouldn't have the money to pay their mortgages, so the landlord would then go into forbearance on that, and it becomes a very vicious cycle.
Mm-hmm.
So landlords aren't going to want to rent to people who've shown a predilection to not making their payments on time. But if they can
Mm-hmm.
see why it happened, let's say they were a restaurant owner and they've been forced to shut down yet again, and so
Mm-hmm.
that's why they're not making their payments. Well,
Mm-hmm.
when everything recovers, people are going to eat. That's a good business to be in when they're allowed to be in
Yeah,
business.
exactly, exactly. Yeah. But then restaurants, I mean, like some of them are closing because then I guess they haven't really adjusted to the new
Mhm.
COVID. But hopefully, like the ones that can still to dine out, take out delivery, they're still surviving. So okay, I'm looking at
But
a
some of them are
comment.
just barely
Oh, go
surviving.
yeah, yeah. John Lim is asking, please talk importance of emergency cash reserve. So yeah, I cannot stress the importance of that. Of course, it's very important, but I mean, like Russell says, sometimes when you get laid off, sometimes people just don't have it, and then like and you try your best to help those people, but sometimes they come to me too late as well. So but then I cannot stress it enough. You need to have emergency cash reserve at least 3 months, 6 months, or a year, depending on your situation, and then how marketable your skills are in finding a job. So if you feel it's gonna take you about a year to find another job, then you need at least a year of emergency cash reserve. If you're very high in demand, your career, especially if you're in Silicon Valley, you have a very marketable skill, then you might just get a job in a month or less than a month right away. So in Silicon Valley, I think it's not that hard as long as you have a very marketable skill. So hopefully that oh, John asking, should people take money out of 401k to build emergency cash reserve and buy a house? So John, I don't see the point, like you're taking money from 401k to build like emergency cash reserve. I mean, like that leaving the 401k is already your future savings. So I wouldn't take money out just for the emergency cash reserve. It's like to buy a house, yeah, I mean maybe you don't know if that's a good thing or not, right? Because like but right now they're able to actually that now the government is actually saying you don't have to pay the 10% penalty as of now. So we have to see the overall picture, like does it make sense and everything. So I cannot just answer off the bat generally. So it all depends on the person's individual situation. We have to look at the overall picture. I mean, what do you think, Russell? Do you have an
No,
opinion
I
on that?
agree with that. If someone doesn't have cash reserves,
Mm-hmm.
I would much rather see them build up that emergency fund
Yes.
before they pay off the rest of their debt.
Mm-hmm.
Sometimes people count on a large credit line to get them through rocky
Mm-hmm.
situations. Um, I had clients who, in the last crisis, had $1 million HELOCs on their homes because they
Mm-hmm.
had a lot of equity. Well, they went to draw down on those when they got in trouble and found that the bank
Mm-hmm.
had closed the line down.
Mm-hmm.
Um,
Oh,
so you cannot count on credit to be your reserves. So
exactly. It's
if
not
you
a
have a
reserve.
lot,
It's a
if you
credit.
have a lot of debt,
It's
build
not
your
your
reserves
money.
first so that you can service
Yeah,
that debt if you get in trouble.
exactly. Yeah, it's
Then
not your
start
money.
working on paying down the debt. That's
Yes,
right.
yes, yes.
Um,
Yep, yep.
and if someone is in the situation where they are considering liquidating a 401k for their cash reserves, I wouldn't do that because the 401k is always there.
Yeah.
So if they get in real trouble, they can get at that money without
Yep.
pulling it out
Exactly.
in advance. And someone that's in that situation, I would not recommend they buy a house. They need to
Exactly.
be
Exactly.
more ahead of the game before
It's
they commit to something like that.
exactly, exactly. And then yeah, if they have to take money from a 401k, then that probably means they're not in the financial situation to buy a house. Again, like I don't want to just say general, like
Generally, yeah.
I have to see how each individual situation. But generally, yes. I mean, like if you are generally if you already have enough cash reserve, you have a good financial standing, then you're ready to buy a house. And then some people, like I also have to ask the question, try to figure out like what is the real motivation for the person to want to buy a house. And usually it's because for status symbol or whatever, like then that might be the wrong reason. And then sometimes buying a house just doesn't make sense where they are at in life as well. So
Mhm.
I need to see like the overall where they're at in their life, like how they are good doing financially, and then see if that even makes sense. Okay, so yeah, so I know we already talked about this, like so people who's going on forbearance on their mortgage, like how are they getting affected now? And then for when you say forbearance, that's like they completely stop paying or they just lowering the payment right now.
Usually people that go into forbearance are completely ceasing their payments. That's what they're allowed to do under the guidelines. But one thing that some lenders are doing is if you even call them up and ask them what the procedures are for forbearance, they just put you in the program. And so your credit report will say you're in forbearance, even if you've made all the payments in the meantime. And so that's been a big problem, because if you're in forbearance, you can't refinance. Well, they know that you can't refinance if you're in forbearance. So if you're paying them a high rate and they want to keep that servicing on their portfolio, they can push you into forbearance if you've made any kind of a request that they can justify saying you asked for it. And that stops you from refinancing.
God. So it's just weird. So we this home is under Chase, and when we called them a forbearance, they told us that it's not being offered.
Okay.
I mean, not
So,
all
for
banks
example,
were.
my father's home loan is with Chase right now.
Okay.
We actually originally did it probably 8 years ago, and we did it with MetLife, and subsequently they sold it to Chase. That's a Fannie Mae or Freddie Mac loan. That was a conventional loan when we did it. So
Yeah.
if he called and asked for forbearance, they would be obligated to give it to him. But Chase is a mega bank. So they have billions of dollars of home loans on their books. That's their money that they took from depositors to make loans. So they are probably not obligated, if it's their money, to offer the forbearance.
Got it.
They probably would, though, if you insisted. You might have to hang up and call again. A lot of times when you're dealing with financial services companies or credit issues or anything, sometimes you just get someone who's not going to help you.
Yeah. That's true.
And,
That's true.
if I had a client that needed that, I'd tell them to just call every day, get a different person every time, because they have thousands of people answering those phones. The chances that person's going to remember you. Now, you have to be nice to each one. You can't argue with them. You can't fight. You can't swear at them, because they record the calls. And then some person might listen to what you told the last guy. But if there are genuinely people at those companies that want to help you. And if they've got a way to make it happen, they would. So I just say, hang up and call again.
Yeah. That's like Comcast. Keep calling till you get the right person. It's ridiculous. It's actually ridiculous. It's ridiculous with Comcast, because like there's no competition. Then they try to jack up the price on you, and then you have to call to have a promotional stuff. Okay, John has one more question. With rates so low, if someone has no mortgage, do you recommend they borrow now?
That would depend if they have a need for the money. If they have no savings and they wanted to borrow money at these low rates, that's fine. Now, cash out mortgages cost a little bit more than a regular mortgage because it's higher risk to the lender. But you can still get, I've got someone looking at a cash out mortgage on a 15-year fixed, and they're still below 3%. So it just depends. If you have the income to make the payments and you have a reason to want the money in the bank, that's fine.
Yeah. So Russell, can you explain what cash out mortgage is? Is this the same as refinancing? Like, for example, you already have that equity and you refinance so you can get some cash back, or is this different?
Yeah. So let's say you owe $400,000 and your house is worth $1 million, real common for the Bay Area. Okay. If you just want to refinance and borrow the $400,000 or 402, 403, whatever you need to cover your closing costs, that's considered a rate and term refinance. And so those are offered with the best terms. If you want to take out $500,000, you still have plenty of equity. That's 50% loan to value. But it is considered a higher risk because you're withdrawing cash from your home. So they bump the interest rate up slightly, or they bump up the costs. Okay. Yes, it's more expensive.
So you're taking more and more cash out, then they will actually bump it up. Yeah. Okay. Got it.
Now, if you do a cash out home loan above 510, 400 for counties that are high cost counties, then the penalties get really high.
Okay. The higher the cash out, then okay.
No, it's because if you go over 510, 400 up to 765, 600, there's an additional, basically 1.25 minimum additional hit for the cash out. So on a $700,000 loan, 1.25, that's $10,000 in closing costs to get that cash out.
Mm.
So in order to do that, usually when people need the cash, they raise their interest rate higher to try to get the bank to cover it. But sometimes there isn't enough room left on the table for them
Mhm.
to cover all the closing costs, and it may be
Mhm.
very expensive to get the cash.
Got it. So closing costs, when you buy either a resale. Okay, so let's talk about the different type of closing costs. So there's the brand new home, there's resale home, and refinancing. So tell
Mhm.
me what does those closing costs really pay for? Like they're like so expensive. How many? Okay, let's start with the brand new home and then the resale before we do the refinance of an existing home.
Mhm.
So what does the closing costs cover? And then usually they can get up to 10,000 depending on the value of the home.
So it just depends. When it comes to the brand new homes, part of the closing costs depend on, first of all, if the city or county has extra costs because of the subdivision or there are additional things that are being subsidized. Um, Usually, the closing costs for a new construction, I found um, them to be lower because the builder negotiates with the title company to get lower than normal fees for the entire subdivision at once. And
Mm-hmm.
since the builder used that title company to acquire the lot to begin with, the land,
Mm-hmm.
um, they're already on the hook for the chain of title and everything. So
Mm-hmm.
they
Mm-hmm.
can make it more economical. What I generally tell your average first time home buyer, let's say someone's buying a $500,000 home, um, they should plan on about 13,500 to 14,000 in total closing costs. Now that includes setting up their impound account for their reserves so they can pay their taxes and insurance monthly.
Mm-hmm.
Um, and it just ends up being about 2.5 to 2.75% in those cases. Now,
Mm-hmm.
if they don't want to have the impound account, they can save some of the upfront costs, but it's still going to be in that case
Mm-hmm.
$6,000 or $8,000 in hard costs that they have to come up with.
So okay, so to
You
set
can
up an
have the seller
S.
pay it though.
Oh, okay. So the escrow to set up an escrow account actually costs you money. So better
It's not that it costs
don't do
you
the
money. It's that you have to
Mm-hmm.
come up with money in advance. For example, I have someone right now who's refinancing that wants to keep an impound account, even though they don't need it. They have a ton of
Mm-hmm.
equity, but
Yeah.
they don't want to think about their taxes when they come due. So we're going to close that loan in August, and they're going
Mm-hmm.
to have to come up with 7 or 8 months worth of property taxes right then, because
Oh,
on
got it.
November. So if we close in August, their first payment's not till October 1st.
Got it. Okay.
Well, on November 1st, that lender has to have 6 months in the account to pay it. And they'll have only
Oh, okay.
gotten one payment from them. That's not the real problem, though. The next installment is due February 1st.
Mm-hmm.
So on February 1st, they need 6 months again, even though the space between November and February is only 3 months. So that's why they have to come up with 8 months now, because otherwise in February, they won't have six.
Mm-hmm.
So right now is about the worst time of year to
Mm-hmm.
be refinancing and setting up an impound account because they're going to take the most. But that same person has already been paying into their impound account to the previous lender. They get all that money back. It just takes a few weeks.
Mm-hmm. Okay, yeah, that's why I don't know. I prefer. I think. Well, I don't have an escrow account because like I'd rather
Mhm.
just manage my own money. So it doesn't really
Mhm.
cost. There's no additional fees. It's just more like
It's no additional
okay,
fees. It's that you
got it,
have to spend the money before you
got it,
want to.
got it. Okay, I got it. Okay, so you said it's about $8,000 hard money on closing costs. Like if you had to break that down, like that goes to title company, that goes to
So your typical lender is going to have about $1,000 in their underwriting fees. Uh,
okay.
Here in the Bay Area, your appraisal might be $650.
Mm-hmm.
You're going to have tax service, which is a service that's going to watch you every year, make sure you paid your taxes. Tell the lender if you didn't, because
Mm-hmm.
if you let it go 5 years and the state decides to foreclose on your home, their lien is senior
Mm-hmm.
to the lender, which means
Mm-hmm.
if the lender wants to maintain their security, they would have to pay off your taxes to stay in
Mm-hmm.
first position.
Yeah,
So,
got it.
so you're paying that company to tell on you if you skip your tax payments.
Okay.
Um, there's a flood service, which is cheap, but they make sure
Mm-hmm.
that if your home is ever added to a high high risk flood zone, that the
Mm-hmm.
lender is notified so they can make you get flood insurance.
Mm-hmm.
And then you have typical recording fees, transfer taxes, and things like that. On a $500,000 home, that could be another $1,000. Um, Now, if it's in Oakland or Berkeley, that could be
Mm-hmm.
$5,000 instead of 1,000
Mm-hmm.
because they have
Got it.
additional fees.
Yeah.
And then the title insurance and the escrow fees, it just all
Mhm.
adds up.
So do they typically finance the closing costs? Like that's typical, like they just add that to the
No,
loan?
in most cases, you cannot add the closing costs to the loan.
Mm.
So the closing costs are in addition, but the hard closing costs can be paid by the lender. If you increase the interest rate, the lender will give you a credit to help do
Mhm.
that. Um, for example, someone who I spoke with just yesterday is refinancing. They are getting a total of a $7,000 credit towards their closing
Mhm.
costs.
Mhm.
Their closing costs, the hard costs are only going to be about $3,000 on that loan.
Mhm.
So they'll have $4,000, which the
Mhm.
lender's still going to give them, and
Mhm.
they can use that to start to help pay their impound account they want to set up.
Mm. Got it. Got it. Okay. So the brand new and resale home, the closing cost is probably similar. What about for a refinance home for, for your current home? Like, is the closing cost typically lower? Like, what cost is not there in a
It's
refinance?
typically lower because when you refinance, you don't have to pay for owner's title insurance again.
Mm,
Now, owner's title insurance is optional. You actually don't have to pay it when you buy a
mhm,
house, but it would be foolish not to, because if if someone showed up later claiming that they owned the house instead of the people who sold it to you, you want to have that coverage.
mhm.
You don't
Got
want to have unlimited liability there to where you could lose everything.
got it.
Um, so that's the main cost. And owner's coverage on a $500,000 home, that could be $1,500 of those closing costs.
Mhm,
Likewise, the cost to refinance on the title and escrow side is a little bit cheaper because they're relying on the insurance that you already had, and so they get a reduced premium,
mhm.
and it's less complicated, so the escrow fees tend to be lower also.
Got it. Got it. Okay. So okay, so it's slightly lower for refinance, and then okay, so someone asked with rates. Oh, no, 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 actually that we re-asked that. Okay. John asked again, do you recommend people pay points to buy down the rate?
Almost never.
Why is that?
The reason banks offer you a cheaper rate in exchange for more money up front is they have calculated that in most cases that's a better deal for the bank.
Because they're gonna end up refinancing anyway later, right? But you already
So
pay the points up
if
front.
you can hit the very bottom of the market and you know it's never going to go any lower than this, then you can
Mm-hmm.
pay a bunch of points and you'll save money.
Mm-hmm.
But
Yep.
only time I've ever seen it actually work out in the client's favor,
Mm-hmm.
maybe right now, but we won't know that for 5 or 6 years.
Mm-hmm.
In April of 2004, it would have been possible to pay extra to get a cheaper rate. Generally, it takes between 5 and 7 years to make up whatever you pay. Okay.
Mm-hmm. Yeah.
So that person would have broken even by 2009 or 2010. And rates
Mm-hmm.
were still higher then than they were in 2004. Okay.
Mm.
Because we were in an unprecedented crisis that had happened that had just made everything get bad. But that same person still would have refinanced in 2012 because rates were even cheaper. And in 2012, if you go forward 5 or 6 years, that person couldn't have broken even because in
Mm-hmm.
2016 rates were even cheaper.
Mm-hmm.
And that that Monday, 3 weeks before the presidential election in 2016, when I had the lowest rates I'd ever had, if someone on that day had paid extra, they wouldn't have broken even yet, and rates are already cheaper. Okay, so it almost never pencils out to have been in the client's best interest in hindsight.
So okay, with when there's cost to refinancing, when is a good time to refinance? Like how low from your current mortgage is it worth it to refinance? Like how
Okay,
do you determine and do the analysis? Because there's closing costs. It could be up to $10,000 closing costs, like few $1,000s at least. So when is it worth it to refinance? And then like how much lower than
so
your current rate?
anytime you can get a cheaper rate and have the bank pay all the costs for you, that's a good idea. You should at least do that.
Okay.
You can calculate out whether it's worth it to pay more cost for an even cheaper rate. Um, Let me give you an example of one couple that I've been dealing with. When they bought their home, they talked about paying extra money
Mm-hmm.
to to refinance or not to refinance, but to buy down the rate then, because rates had gone up.
Yeah.
Rates at that time were about 5 3/8 for them.
Yeah.
Okay. 6 months later, we refinanced them. No points, no fees at 4.5. So they wouldn't have made up the difference in those 6 months.
Yeah.
6 months later, we refinanced them again at 4%. Again, no points, no fees. Okay.
Oh, so the lender absorbed
The lender
everything.
pays the costs,
Oh,
and
so it doesn't cost anything.
they
Wow, that's
just
good.
refinanced again at
Yeah.
3.08%. No
Mm,
points, no fees.
got it. Got it.
So
Okay.
this is the fourth home loan these guys have had.
Mm,
They haven't paid any closing costs on any of the refinances,
got
and
it.
their rate is now 1.25 cheaper than what they started with.
Yeah. So is it normal, or are there a lot of lenders that offer no closing costs ago at all for refinancing? Is that pretty common?
I would say about 3/4 to 80% of my lenders offer it on most transactions right now.
Got it. Right now at
The
this
rate,
current
the rate's
economy.
higher than what they'll offer if you're willing to pay. But again, if that higher rate is still a lot lower than what you're paying, you should at least take that.
Got it.
And you
Got it.
can
Okay.
calculate out. Now, here's a reason why you might want to pay closing costs. Let's say you're nearing retirement and you're making a lot of money right now, but you won't be making money in the future. So this might be the last time you can qualify to refinance.
Oh, okay.
One
Yeah.
one of the things that's come out since the last financial crisis is in Dodd-Frank, they instituted what they call the ability to repay rule. So it's against the law for someone to loan you money on your home if they don't have a way to verify you have the way to make those payments,
Okay.
which usually means they use your tax returns. And so, or for example, let's say you're going to be quitting your job because you're going to start your own company. Well, if you start up a company, you're probably a couple of years away from paying yourself anything, and you need 2 years of profitability to have income that the lenders are going to use to qualify you. So you might be thinking down the road, it's going to be 5 or 10 years before I can even show enough income to qualify again. So I want that payment to be as low as possible. There are reasons to do it, but not for most people most of the time.
Yeah. So for most people, I mean, you can just like, let's say it costs you, 10 grand, well, at least for the initial closing cost, but then let's say it's 4%, whatever. So they don't have to worry because later on they can just refi. If the market goes down, then they can it doesn't cost them anything anyway. Then they can keep refinancing if the mortgage interest goes down, right? Because it doesn't cost them anything, like you said. Okay. So I know you talk about this. So it's like, how can tax pros make money by providing mortgages for their clients? Like, what do you mean by
Okay.
providing mortgage? Like me,
So
like,
here's what I do.
Okay.
This is one of the things that I got patented. And I came up with this idea in 1998, where I think you know that paying a referral fee on mortgages is against the law.
Okay.
If you, as a financial professional, received a referral fee from a mortgage company for a residential loan, you could go to jail. They could go to jail.
But there's okay.
Yeah, referral fees. A referral fee is illegal when it
But
comes
for
to
realtors, there are referral fees.
realtors can pay. Okay, so same law, RESPA. It applies to the transaction, but the National Association of Realtors, they are really good at lobbying. So they have a carve out to where licensed real estate agents, or licensed real estate brokers, can pay a referral fee to another licensed real estate broker, literally just for a name and phone number. And that's legal. But it's disclosed in the transaction, and so you can see it on the closing statement, but it's completely legal. But, one of my best friends owns a mortgage company up in the foothills, and he sent me a transaction that he can't do because he doesn't have a lender for it and didn't want to do it. So I did it. I cannot pay him a referral fee, even though we're both real estate brokers, because the mortgage transaction is something that is absolutely, you cannot share any of those fees. You can't pay a referral fee. You can't split fees. You can't do any of that.
Yep. Yeah. So how can we
what
make
I do
money
for the
then?
tax pros is I teach them how to be a loan originator. I help them get the licenses they need.
Okay.
And I pay them for providing the home loan to their clients. And so what they do is, let's say an average independent CPA has 300 clients.
Mm-hmm.
Okay. Any given year, even when we're not in this kind of a market, in any given year, probably 30 to 45 of them are going to get some kind of a real estate finance transaction.
Yeah.
They're going to buy or sell. They're going to need cash out. They're going to want to lower their interest rate. They're going to have a loan that comes due. That's going to happen to 10 to 15% of his clients every single year, no matter what.
Yep.
And so what I tell them is, talk to your clients, tell them you're doing this, tell them you'll track their interest rate with our patented rate tracking system.
Mm-hmm.
And that whenever they can save money and not pay any closing costs, you're going to tell them.
Mm-hmm.
And what I also tell them is, if every time interest rate drops, you save them another $150 a month, they're never going to try to replace you with TurboTax.
Mm-hmm. Yeah.
And we pay them good money for doing it. Since 1999, when that became legal in California for CPAs, they got deregulated as to receiving commissioned income. We've paid out about $15 million in commissions to those independent agents for doing this with their clients. And so they're licensed as my agents, and it's fantastic money. And the systems that I wrote to make this happen help them do so many of the steps that it only takes them about an hour to do that work. And we pay them 0.5% of the loan amount. So if they do a $500,000 refinance for their clients, that's a $2,500 commission when it's done.
Yeah. So if they're interested, how does that work if they want to be a loan originator?
So they have to get licensed, and we can walk them through that. And,
What kind of license?
in California, you need the Department of Real Estate salesperson license, and then you have to get the NMLS endorsement to that license.
Okay.
In Utah, they just need to get the NMLS endorsement.
Okay. So it's not the real estate license.
It is a real estate license.
Oh, so if
But it's
I'm
a
a
real
real
estate plus
Okay.
the NMLS.
Okay, so if I become a realtor, I can do loan originator. I can offer that.
If you become a real estate agent
Yeah.
and hang your license with my company, if you became a realtor, you couldn't necessarily, because I'd have to pay your broker, not you.
Okay.
So you have to be my agent for me to pay you.
Okay. Got
But
it.
yeah, you get the real estate license, you get the NMLS endorsement to that license, and you can literally type in the information on 7 screens, collect some data, do some educating for your clients, be there for them, and look out for their best interests.
Yeah.
And you can get paid good money for doing that.
Got it. Wow, you have such a ton of knowledge, Russell. I love it. So yeah, I mean, okay, so we're almost at the hour. So like, do you have anything else you want to share with people, like, regarding the mortgages, like I guess if people I guess want
Yeah.
yeah.
So this is something I've been harping on a lot. I'm sure you've seen videos from me talking about this. This has nothing to do with my business, but because I have so much experience with credit, this is like a crusade that I'm on. I tell people that they should opt out of pre-screened credit offers. The reason being, a lot of those offers that they're being given, that they get in the mail, they're always bad. When I get stuff in the mail from places saying you can get this money, you can get that money, a lot of times all it is a bait and switch. They want you to call in so they can trick you into signing up for debt relief. And I have even seen CPAs calling those numbers, getting tricked into signing up for debt relief, which ruins their credit for years to come. And so what I tell people is, go to optoutprescreen.com. That's the website that Equifax, Experian, and TransUnion had to establish to make it so that they can't sell your information if you opt out of it. That's what they're doing. They're selling your information to people that are going to try to rip you off. I just think that's wrong.
Yeah.
So that's just a side note that I tell just about everybody.
Yeah.
That doesn't have anything really to do with my business. But what were you going to say?
Oh no, someone just made a comment. Actually, this is Michonne. I'm not sure why her name's not showing up. She said, "I don't understand the integrity of when a realtor represents the buyer but works for a company who has another realtor who represents the seller. How does that work? And they not talk to each other about the transaction?"
Okay, so when it comes to dual representation, again, I actually am a realtor, but I don't really do anything with that portion of my license. But if two salespersons work for the same realtor, technically the contract isn't with the sales agent, it's with the broker. The broker is the key to making everything happen. The sales agents don't have permission to work without the broker's blessing. So if two agents in the same office are representing both sides of the transaction, technically that's dual agency on behalf of the broker. In my experience in the reputable shops, those agents don't share information back and forth. As a matter of fact, if, let's say, they have a home that's gone pending, but it's not public yet because it hasn't closed, they won't even share the information about what the sales price is or what was negotiated, what the terms are, until after it's closed. The ones that are ethical really take the responsibility seriously to not be sharing information they're not supposed to. Now, if you're working with the same agent for both the buy side and the sell side, that gets more complicated because that agent has to kind of step back and not be as aggressive in telling both sides what to do and what to ask for, what they can do, because they have to be completely impartial and not share any confidential information. You know, they can't say, I happen to know that seller will sell for $50,000 less. They can't say that, even if the seller has told them that they would do that. But yeah, to answer the user's question, it is possible, but it's more likely that if you're dealing with two different agents that do a lot of business, they're going to be taking it very seriously because of the repercussions. And, you know, it's a really good living for people that have built up that business, but it takes them years to do it. And they don't want to risk that over a single transaction.
Got it. Okay. Thank you for that, Russell. Thanks for the good question. Okay. So, Russell, why don't you tell people how can they find you? Like, where do you hang out most of the time?
Okay. So you can find me on LinkedIn. My LinkedIn name is Russell McDonald.
I'll tag you so people can find
Perfect.
and connect to you.
So I'm also on all the social medias. So you can find me on Instagram and Twitter at either YMAC Capital or Tradmore Mortgage is my usernames there. And when we go on this, I'll type in all the information in one of the comments on the video. So here's what's happened. Can I tell you a brief story here?
Yeah, sure. Go ahead.
So I started at this company in 1990 helping with the computers. No, 1991 helping with the computers. And then I got licensed in 1992. Yeah. And I invented all the systems they've used to make their money for most of the last 30 years. And did a lot of the other things. In 2015, the founders decided to retire, and I was passed over to inherit the company. They gave it to my little brother and the owner of the son of the other owner. So they took over in 2015, January 2015, and then 3 years later they fired me. Oh. Okay. See ya. So they fired me, and so I started another mortgage company with my wife. Okay. That's Tradmore. That's where you've probably seen most of my stuff, because up until recently, that was the focus of my business, was Tradmore. Yep. Then May 1st this year, I bought them out and took over the old company, which is about 20 times as big as my new one. So now I'm running two different mortgage companies, because what happened is my brother and his partner decided, they realized they didn't like running a company. Yeah. It's hard. And a lot of the stuff that I was doing, I didn't do for them anymore once they kicked me out the door, obviously. And it wasn't working for them. And so my brother's looking for a job in tech, because he was originally hired. I hired him originally to be the IT manager for us. And his partner's gone back to school and is going to get an MBA and think he's going to get a better position that way. So literally May 1st, I took over this company in the middle of all this going on. Yeah. And I'm in the process right now of trying to regrow the CPA portion of the business, or not just CPAs, any tax professionals or financial planners. This works really well for them. Got it. Okay.
Well, that makes sense.
That's why my social media is so spread out, is all the stuff I've done for Tradmore doesn't really work, because nobody knows who Tradmore is. It's only been around for a couple years, and it doesn't have the penetration. YMAC Capital's been around for 30 years, and we've worked with more than 500 different independent CPAs and financial planners over the years. And at one point we had 6 offices. Now we're consolidated here in the Bay Area, but we're starting to grow out again.
Mhm.
So I'm in the process right now of building social media channels for YMAC Capital. And one of the things that one of my coaches has said is that I need to build my own channel independent of the companies, and then end up hiring other people to grow the different needs of the company channels. So
Got it.
that's where I'm at right now.
Okay, cool. Yeah, that's good to know. Yeah, you have a lot going on, Russell, and then I love that you're always
It's
continuously trying
crazy.
to. Huh?
It's crazy everything that's going on right now.
That's good. That a busy business is a thriving business. So
Just the last 6 months of this year are going to make my best year ever. And I've been in business for 30 years. So
good.
I'm really excited about the stuff that we have going on right now.
Awesome. That's very very good. Yeah. So yeah, Russell, just yeah, just stay on after this. So thank you so much for joining. I really appreciate this. I learned a lot, and then I hope everyone learned a lot as well. Like we got a lot of good questions. So thank you so much everyone for joining. Yeah, just stay on, Russell.
Thanks, Christine.
Bye everyone.